Hey, welcome back in the podcast. Thanks for joining us today. Hey, we have Brian Cushing in here today. We're going to be talking about rate volatility, and we're also going to go over the market conditions for January. Everything's changing quite a bit, so we'll always bring Brian in to get what's going on the lending side. So, how's it going, Brian?
It's going good.
Good. It's good to see you.
Appreciate you having me in the new studio.
Yeah, the new studio. So Brian has some big news. Actually, he's kind of switched companies. Tell us a little bit about your new company.
Yeah, well, I started at Essex Mortgage this month. Exciting times to open a new branch and a new brand for Northern Nevada. So, mortgages are 30-year fixed, and my company will service the loans, which was really important for me and my clients. And we also get the opportunity to broker some loans that otherwise would be something you have to turn away if it's more like an investment property. There's some great programs out there, and I needed the flexibility to do those.
Yeah, so more flexibility, so more time than ever to call Brian if you have an unusual loan. Now he has the ability to get it through. So, All right, so let's go over the numbers. We got the numbers right here, but the reason why you're going to want to really stay around is we're going to talk about how to deal with the volatility of the world and interest rates, because there's a lot going on, and every time we turn around, there's more volatility. Things are changing quickly. So we're going to dive into how to handle that in a real estate perspective. So, ready? So I'll start out with the median home price. Median home price is $515,000, and it's down 8% year over year. So we haven't seen that quite a while where we actually have a loss in the last 12 months, probably in the last 10 years. And we're actually down about 0.3%. So market's settling down, and the pace is definitely slowing, and it has something to do with the cold winter, but also just because the economic times right now aren't as good as they have been, inflation. So, What about closed sales, Brian?
257 closed sales in January 2023. That is 43% lower. I think that's the year over year.
Yeah,
number.
year over year, yep.
And then 29% lower just since December. So a lot slower, a lot less transactions. And just kind of on the median sales price, I'm pretty sure you called it a couple months ago. You're just a few months early on the lower median price. So.
Yeah, so not a lot of sales. I mean, if you think about this, is essentially 250 sales for all of Reno Sparks.
Well, that means that half of them were under 515,000, half were over. So I think that the median price will go up as more sales take place. But we need more listings.
Right. And then, which are coming, I think, but we'll see with rates.
All right.
So, median home price. So here's another important metric you want to look at and see how the health of the market is and really what's going on. I mean, if you want to go deeper, this is the next deeper number. Median days on market, meaning once you list it, how many days till you get a contract? And we're at 56. And that's up a whopping, get this, 650% year over year, and up about 4% month over month. So sellers need to readjust, and so do buyers, that houses are not going to fly off the market in the first weekend, and we're going back to what it was before the hot market, which is it's relatively common in a regular market. I know we haven't had one in 10 years, where a house sits for 60 to 90 days before it gets an offer. I know that's hard to believe, but that's what's...
Well, some people actually have time to come see it and sleep on it and make a reasonable decision in the next 60 days.
It is really nice for buyers, and I'm not missing those days where we were literally on the kitchen counter writing up an offer, blocking people from seeing it, trying to get the offer in before he went. So, it's kind of a crazy time. So our favorite number, Brian's going to go over our favorite number in these stats.
Oh, God. So list price received. So they have a stat that's 97.4% of the list price that's received. I'm assuming it's after it's closed. So of the 257 transactions, they received 97.4% of their list price.
Yep.
It's got to be the last list price before the offer is accepted. So if they listed it, 6 months ago and then dropped the price 15 times, it's just that last price before they.
So how about we do this? We do this every month. Let's not talk about that one anymore.
We're going to skip it.
Because it has no relevance. It means nothing, and I wish they'd get rid of it. It would be nice. Anybody out there that has powers to be at the real estate board down there, how about you guys come up with a what the actual list price based on what was sold. So if you listed for 500,000, you sold for 300,000, that would be the percentage that would be interesting to anybody out there. So we're gonna skip that from now on.
All right, good. I like that.
All right, so here's another one that I don't particularly like, but we're gonna do it anyways, just to kind of give you, if you're out and about, kind of give you a rule of thumb. And if you see stats around the country, it'll give you an idea of what's going on locally. It's the median home price per square foot. Now we always talk about this can vary a couple hundred dollars per neighborhood, but the average is 289. So the median is 289, which is about down 4% year over year and up about 1.4% from December. So 289. So you can kind of go out there and put your thumb out and kind of get an idea about what a price of a house should be.
So if you see it over 300,000, you should worry.
If you see over 300, if you see 400 per square foot, you're probably talking a really custom home. And anything less than 200, you're probably talking about a fixer-upper.
Or maybe it's a 700 square foot condo.
That's right. That's true. So take it away with new listings.
All right, 292 new listings. Now compared to 257 closed sales, that means there was a few more listings on the market than sold, which that's adding to the market, slowly but surely.
40 houses, or no, wait, what is that? 30?
Yeah.
35 houses.
But the 39% year over year, that's 39% lower since January 2022. So even in the cold winter of 2022, there was more listings coming on in January than this year. So I think that speaks to the interest rates, or maybe stopping people from listing their house. I don't know. Maybe that's it.
Well, I mean, we've had a monster winter. I mean, it's been cold. We were just talking about. It's nice when I'm at Mount Rose, but it's not nice when I am anywhere else because it's just cold. It's been a cold winter. So, I mean, I hope we get some more snow, but for the sake of the market, hopefully it kind of warms up and we have a non-miracle March.
Well, let's thaw out in April for sure.
Yeah, so active inventory. So active inventory sits around 780. It's up, as you would expect in a slowing market, 125% year over year, and down about 21% month over month. So there are houses that are available out there, but they're sitting for that 60 days. So
yeah.
What about supply months of inventory?
So 3 months of inventory. Now that seems pretty healthy. Right?
Yes, I mean compared to 0.2, 0.1, it's getting in
Point
the
anything.
Yeah, how much is it up?
So 3 months of inventory just means that 257 closings, based on the 780 homes for sale, it would take 3 months to absorb all that, assuming that no new listings came on the market.
That's a beautiful description. And just keep in mind, we talk about a lot, in a normal market where buyers and sellers have equal footing, we're about 4 to 6 months of inventory. So we're quickly getting into an area where buyers and sellers have equal power, which is nice.
More balance for sure.
Yeah, because it was getting tough. So if you guys have any questions about the market conditions or want a one-to-one to talk about what's going on out there, you can always give us a call. But we're going to jump into the anticipated discussion, which is, there's a lot of volatility out there. I think the rates are up quite a bit very quickly. So Brian and I are going to kind of go down a list of how do we deal with the volatility of not only interest rates, but the real estate market.
Well, I think my note was just that you got to get used to it. Volatility is everywhere. The stock market, if you don't look at your retirement account often, good for you. Don't do it because it's been going bananas.
Up and down, yep.
And it's really the way you deal with it is you have a plan, and hopefully you have a long-term plan, I like to just lay out a goal for someone. So get used to volatility. It's not exciting. It's actually pretty stressful. But hire a professional. You need to have a professional guide you through the process. Sometimes you're going to want to jump off the cliff, and then that professional can hopefully get you to come back, right, to the right side of things. So understand that you lock interest rates on a house with a closing date. So it's very specific to the property. Okay, so what's happening when you lock in your loan rate is your lender is locking in the loan that they're going to deliver to the investor in about 2 months. Right. So it's a hedge, right? So if you don't have a house that you cannot close the loan on within that couple months period of time, usually it's locked for 30 days, so you can close your loan, and then the lender sells the loan to the investor the 30 days after that. So you're just going to have to get used to the volatility, and with that, use a worst case scenario. what is the worst case? Like,
that you can afford.
yeah, well, if you heard the interest rates hit 7%, this year, well, okay, let's start with 7%. Is like, can you afford the payment at 7%?
Yep.
If you can buy the rate down to 6%, well, then that'd be fantastic. Or if the rate just drops to 6%, while you're looking for homes, and when you actually go into contract on the home, then that's when you'd be able to take advantage of it. But plan for the worst, hope for the best.
Yeah, and then to expand on that is when you're looking in for a contract, you can talk to your realtor about this and your mortgage professional. There is somewhere on the contract on the first page, halfway down, that says this is an important thing when you're looking at volatility. Is it says how many days you're going to lock your rate from the contract date. So, what is your advice on what number of people should be putting on that right now?
Well, I mean, this is my conversation around gambling, and I am not a gambler. I did not grow up around gambling, and that got me in trouble the first time I got here, and ever since then I've just stayed away from it. So when you go into contract, within the first 5 or 7 days, you should lock your loan.
If it makes sense, yeah.
Well, if it makes sense. If you're worried about your home inspection and you're pretty sure that the basement's not going to pass a pest inspection and you're worried about mold, well, don't lock your loan, right? Wait till you know that you're moving forward in the transaction, but right away get together with your lender and go over where the rates sit for you. It's all based on your credit, your situation, and down payment.
Right.
So once you get that initial quote, if you want to get another quote, then that first 7 days would be the time to do it. And by the time you finish your home inspections, which is usually 2 weeks, within the first 2 weeks, lock your loan.
Yeah, and keep in mind we're both playing. If you want to play, if you're a buyer, obviously you want that number. You can want the full amount of contract to try and do it. Now, if I'm a listing agent, I want you to lock your loan within the first 5 days. So typically, if I'm representing you as a buyer and Brian's representing you, I want to give you the full length to do it so that you have time to, if it goes down, lock it in. Like some days it will drop at 20, 30 basis points, lock it in then.
And then this week it went up 20, 30.
Yeah, so you have to give yourself flexibility, but you need to know where you're at and what your comfortability is, because you can get burned playing the rate game. So what else, Brian?
Because it's gambling. It's a 50-50.
That's right.
So don't be afraid to pay points. Okay, so points, in today's marketplace, the lenders are charging premiums to get these loans in. The big scheme of things, mortgage companies overall do not feel like, and I think economists would agree with this, that rates are not going to stay super elevated forever. Now that's a pretty blanket statement. Forever is a long time, right? Sometime we'll probably run into a financial recession and the Federal Reserve will have to change their policies. Until they change the policies, get used to volatile rates. They've been averaging much higher than they were a year ago. But you can always refinance the loan. So if you're going to pay points, you're investing in that lower interest rate. So,
all right, so what is a point, real quick?
Okay, just for a point. That's a good point. 1% of the loan amount. So if you're borrowing $500,000, it's $5,000. That's 1 point.
Okay, and you can buy down, and it kind of varies depending on the day what the par is. Par is what. Yeah. If you can just get straight across without paying the points, you pay 7%.
Yeah,
but
so
if you
based
pay
on your credit score and down payment. So
yep.
say you've got a 700 credit score and 20% down, your pricing will be par at such and such interest rate. Right? 1 point can usually get you at least about 1/4% off the rate in the initial 1 point. Now, if you start paying 5 points, you're not going to be able to just lower the rate. There's a cost of diminishing returns there. Okay. So
it's not
1 to 2 points. It's not linear. If you can negotiate part of this into your initial contract, then you can have the seller's cost pay towards those points. But if the seller is not willing to play ball, then
yeah. So that's a beautiful point. Is we see a lot on our listings and our buyers. A lot of people are getting sellers to put some money towards either closing costs for repairs or buying down points. So keep that in mind. It's out there. You just have to have a savvy realtor and a savvy lender to know and push the limits on what you can get as a buyer.
Well, be prepared, and I think in a negotiating tactic, if you don't ask, you will not receive.
Right. So. And you have to have and you have to know what the market is, because still a lot of people are out there thinking that's a lot of sellers still think that it's a seller's market, which it is not. So what are the other few items on how to handle volatility?
So I would say probably the biggest thing, if we just kind of step back to the beginning of this thing, what was your goal and your payment? Now, of course, your goal is to buy a house, and a beautiful house with exactly the number of bedrooms for your family and the right, angle to the sun or whatever your items were. But once you get into the house, did you hit your budget or your payment goal? So every house is going to have, at least in Nevada, is going to have a different tax rate. Every property's been assessed. Ken's done videos that he'll attach here that you can understand how they come up with these crazy tax assessments. But the property you're buying that taxes and that HOA fees, whatever those are, and if those fall into your payment, then great, lock in your loan. If you have to pay points to get down to the payment that you really needed in your budget, whether that's to qualify or just to feel comfortable with your monthly payments, know that going in when you make the offer.
Yeah.
Don't find out about it on the 5th day of the contract and you're like, wow, wait a second, this is out of my budget.
Well, that's these are all good points on why you need to talk to a lender and get very comfortable and make sure that you are very close to your mortgage lender, your mortgage broker professional, and you need a good realtor, because you need to figure this stuff out front, because you don't want to be wasting your time getting in the contract to find out that, oh wow, rates are up from 6.5, now we're approaching what is the 30-year today?
I mean, it was getting closer to 7. It's over 6.5.
Yeah, 6, so 7%. So it is up. So anything else?
I think you're going to be able to get used to volatility if you can get prepared, right? So I think the key with dealing with volatility is the more preparation, the better. Now, if you prepare, now, and then you're not going to buy a house for 3 more months, then having a monthly check-in with your lender, get on the Zoom call, or go sit down and get updates. And what's really helpful, and this what I think would help everybody, is if you have some examples. So when you first start looking for houses, everybody has an idea of what they want, and then they go see 2 or 3 houses, and something tells me that shifts a little bit.
Yep, it does.
Okay, so as that shift takes place, it might be a shift by neighborhood, and the different neighborhood that you're looking at now is an older neighborhood, and the property taxes are a little bit less than the newer neighborhood with an HOA that you first looked in.
Right.
Looking over those payments again, maybe the payment's less for the same house price in a different neighborhood just because of the age of the home.
Right.
Okay, so
Yep.
I think the preparation's key, and having those monthly check-ins is pretty important.
Yep. And last point I have is real estate's the long game. So you need to stop thinking that you're going to make 100% on your investment, or 25% like we're seeing. We were seeing 15, 20, 25% increases year over year. That was never realistic. We all knew, and a lot of people are, oh, this is going to continue. It's not. But keep in mind, when you buy a house, you need to play for the long game. So that if you buy for a year, just look what happened. If you bought last January, you're down 8%.
Well,
so you can't look at that and be all down about it. You got to go into living in a house that you're going to live there long term, and it'll be fine over the long term. Short term could be a little bumpy.
You're buying a home, right? So if you're buying a home and you can afford the payment, that should make you happy. That should bring your family joy, bring yourself a place that you can hang your pictures on the wall, and no one's going to give you a hard time about how many holes you punch in it. Or
right.
You will have to change the garage door every so often because things happen. But that's the joy of being a homeowner is the continual investment you'll make in the property, whether that's upgrading and painting the place or replacing the floors. So you're buying a home. You're not buying a stock that you're going to sell.
Right. I mean, eventually we all sell, but look at it at a long-term view. So, Brian, useful information.
Yeah.
It's a stressful time out there, particularly for buyers and sellers alike, because there are sellers that need to sell for various reasons, and there's buyers that need to buy. And with this volatility, I hope we gave you some ideas on how to handle it. So, what's your information? How do they reach you?
775-453-0345 is the best way to reach me. You can phone or text.
Great.
Look forward to talking to you.
Yeah, get in, talk to Brian. He's one of the best in the business. And please like our videos. As you can kind of see, we're trying out different locations. You can kind of see we have different angles. We're kind of leveling up here, and it's really paid off. And we're getting a lot more views. So if you have a friend out there that wants to know about what's going on in Reno, share this video, like our videos, and stay tuned.
Yeah, give us a thumbs up.
All right, and we'll talk to you soon. Take care. Thanks.